Welcome, everybody, to the VALR Podcast. It's a great pleasure to be able to welcome Eric Balchunas. I hope I got that right. And
yeah, I'll give it a 9.5 out of 10.
Okay, that's some improvement. I'll take that. So Eric, we're really honored to have him on the show. He is the senior ETF analyst at Bloomberg, probably the senior ETF analyst at Bloomberg. Over 2 decades of experience at Bloomberg, which is great. He writes articles, feature stories, blog posts, etc. for Bloomberg.com, appears on Bloomberg TV, radio to discuss ETFs. He's really the preeminent voice out there on ETFs. So Eric, wonderful to have you. I know you're also an author as well. The Institutional ETF Toolbox, as well as the Bogle Effect. So it's really wonderful to have you on the show. Excited to share your insights with our listeners.
Good to be here.
Wonderful. Maybe just to start off with, one of the hopes for this session together is really to break down what ETFs are. We'll then go into the crypto ETFs, Bitcoin, Ether, and the future of what other ETFs may look like. But let's really take it down to the basics. What is an ETF and how does it work?
Yeah, most people know what a mutual fund is. So an ETF is just a mutual fund with benefits at its core. An ETF is regulated under the same rules as a mutual fund, which are pretty rigorous, which means it's ready for middle America. You know what I mean? Whereas other investments like hedge funds, you have to have a certain amount of money because they're more sketchy. But to get an ETF or a mutual fund listed, you've got to have all kinds of checks and balances and processes in place and legal protections and all this. So they're highly regulated. But what people love about them is, unlike a mutual fund, that you can trade them all day, intraday. They tend to be very cheap, which is, I'd argue, that's probably the biggest advantage. They tend to track indexes, and they're transparent, so you can see what they hold every day. So, I mean, we can go a little further. They're very tax efficient too. You rarely get a capital gains distribution with an ETF like you do with a mutual fund. So I just gave you like 4 or 5 pretty major advantages over a mutual fund. So I had covered mutual funds early in my career as a reporter. And when I started covering ETFs for Bloomberg as a data guy, I was like, wow, this is like 5 evolutionary steps beyond the mutual fund. It does everything the mutual fund does, but like 5 other things. And so I dropped everything and dedicated my whole career to ETFs in about 2006. And I was right. I had a feeling they would sort of become the predominant investment vehicle, and they have. And so one other underrated thing here is, over time, you know how people like to build portfolios? Whether you're building a portfolio for the long term or you're actively trading, to me, ETFs fit better in the modern brain and the modern tech system. So not only are they on every brokerage exchange and easy to get to, whatever, but in a portfolio, it's like, oh, okay, I just read China's doing a massive QE program. Let me add a little China to my portfolio. Well, who in the hell knows what stock to pick over there? I mean, I don't. But there's 10 China ETFs that are highly liquid, cover the whole market. Boom, you increase your China. You know what? The S&P is feels a little high valuation. We got election coming up. Let me decrease some of that exposure. And so portfolios are now run more like top-down macro portfolios, where you just tweak your allocations rather than you're running around trying to pick the next big stock. So to me, ETFs fit really nicely in the way people are being more active through their allocation decisions rather than individual stock picking. So that's an underrated benefit, but all those things together are why they've kind of, blown up to the portion that they have. And they take in almost the majority of every new dollar in America. Like, they take in most of them.
Got you. There's a feeling oftentimes that things have been around forever when you're living with them right now, but ETFs haven't been around forever. So can you just give us a little bit about the history of when did ETFs actually come about and when did they start taking off?
Yeah, ETFs started trading in 1993, but they were incepted in a brain in 1988, believe it or not. It took 4 years for the SEC to get comfortable with this new structure that was filed, but the original idea came from the American Stock Exchange. I mean, you guys are an exchange. You'll love this story. The Amex was in third place. It was NYSE, NASDAQ, and Amex. And this guy, Nate Most and Steve Bloom, they were like, damn, man, we got to figure something out. So they were down on their luck and they couldn't get stocks to list there. So they thought, and this is the quote, if we can't get Volkswagen to list here, let's create the next Ferrari. So they were looking for something to have traded on the exchange that would be popular. Well, after the 1987 Black Monday market crash, there was an SEC postmortem. And in that postmortem, the SEC talked about market basket instruments. I won't get into the details, but the SEC basically thought if someone would create a market basket instrument that could be traded, people wouldn't have to use futures in Chicago. Anyway, they were like, hey, this is an idea. So they created a market basket proposal, but they had to fine tune it a little bit. And in order to separate all the costs of the trading from the investors who are sitting there, which is one problem with mutual funds, if people go in and out of a mutual fund, it actually creates costs for the people staying. So they had to figure out how to separate the trading cost from the investors. And this is where this guy, Nate Most, he was older and he had worked at the Pacific Commodities Exchange. And while he was running that exchange, he knew something called commodity warehouses, where you stored individual commodities. So for example, soybean oil. You have a box of soybean oil. You store it in this commodities warehouse and you get a receipt. Then you can trade the receipts with other people. So the receipts trade for all these commodities that are in this warehouse. If you get a bunch of receipts and you want your goods back, you just go to the warehouse. Here's my 10 receipts and you get the goods. This way, people don't have to move the goods around. They could trade the receipts. So he thought, what if we did this? What if we, instead of soybean oil, we did the S&P 500 stocks? So if you want shares of SPY, you gather up the 500 stocks that you need. You hand it into the custodian, and they give you shares of SPY, which is why the first ETF is called SPDR, S&P Depository Receipts. And so that commodity warehouse model applied to stocks, bonds, and now everything else was really ingenious. And that's sort of the secret sauce. And now all the receipts can trade without causing any of the merchandise to have to be moved, thus no taxable events. And that's sort of the genius of the design. And I'll just end there, but they launched SPY. Took a while to get going, but ultimately it was a big hit. One other thing that was underrated about the launch of SPY was that the expense ratio was 20 basis points. And I think that's very cheap for a derivative style product that was being launched, because the Vanguard 500 index fund was 20 basis points at that time, and they wanted to compete with that. That's a big moment because ETFs were quickly seen, even though they were launched to trade and get volume for Amex, they were quickly seen by Barclays as a retail investment. And so people who were early adopters and evangelists, they saw the retail benefit of this. They were like, hell, I can get the S&P for 20 basis points. I can get Japan stocks for under 30 basis points. And a lot of people don't have access to this stuff at that quick and that speed. Normally you'd have to use a futures contract or buy a mutual fund. So the ETF kind of combined the speed of the derivatives with the physical backing of a mutual fund. And they sort of just placated all these audiences. Institutions love the trading capabilities and the fact that you have options on them. You could do whatever you wanted with them, and they're very liquid and quick. And retail, like they were cheap and gave them everything. And so it's one of the rare instruments ever invented, might be the only one, where you've got the biggest investors in the same fund as like mom and pop. Normally they're separated into classes. Here they're all together. And so it's just a fascinating story of how that spawned. But that's the short version. We did a Ken Burns style podcast on this called the ETF story. If you Google that, just Google ETF story trillions, which is my podcast name. It's a 6-part series. It's really good. It goes over. You'll learn it all.
Awesome. Thank you so much. That's great. And can you give us a little bit of a sense of the size of ETFs now? And I don't know if you want to compare that to overall stock market size. I don't know how you generally do that, but give us a sense of the size.
Sure. So ETFs are $10 trillion in the US and $14 trillion globally. And the stock market, last time I checked, is, I want to say, somewhere in the neighborhood of 60 trillion, maybe.
Wow. Okay.
Something like that. Anyway, Lord knows it's probably bigger. It's always bigger than I think it is. Anyway, ETFs, equity ETFs, own about 8%, 9% of all the stocks.
Wow.
So they're still
Okay.
a minority. Equity mutual funds are about the same size. So they own another 8 or 9. So collectively, ETFs and mutual funds own about 16, 17% of the stock market.
And what are the trends of that? I mean, I would imagine the ETFs are growing. Are we seeing them overtaking the mutual funds now, or what do the trends look like?
So it depends where you look. If we look at all ETFs, ETFs have about 33% of the assets of mutual funds. Mutual funds are still bigger. The flows have gone from mutual funds to ETFs like crazy. But because the stock market's gone up so much, mutual funds price appreciation has lifted their assets and kind of like offset the outflows.
Gotcha.
So even though the customer exodus has been moving quickly, I call it the bull market subsidy has kind of made mutual funds hang around because they get this they get the benefit just holding equities and have your assets go up if the market goes up. If there's a bear market, you'll see a lot of consolidation. There's a lot of hollowing out of the customer base of the mutual funds, and ETFs are going to be long lasting. But for now, as long as the markets go up, mutual funds kind of hanging around. But if we take equity, mutual funds, and ETFs are, I think, like 40%. So ETFs are a little higher on the equity side, bond side a little lower, but I think they're 33% of what mutual funds have. But we see them going to overtaking mutual funds in like 7 years. If there's a
Wow.
bear
Okay.
market, it'll happen much faster, as I said, because the bull market subsidy goes away. If the market keeps going up or is flat, it'll take 6, 7 years.
Okay. Got it. Last question on kind of the basics. We hear about ETFs, which is exchange traded fund. You also hear about ETNs, exchange traded notes, and ETPs, exchange traded product. Can you just clarify what an ETF is compared to an ETN or ETP?
Sure. So for everybody out there, most people are just going to use ETFs. Like I call that vanilla. Like 95% of the assets are in like basically vanilla ETFs, which are just like mutual funds filed under the 1940 Act. But there is like 5-10% of the ETF market that just got sort of grandfathered in that is a little weird. ETNs are exchange traded notes. Those are just notes issued by a bank, but they do work the same way as an ETF with creation and redemption. So I think it's fair that they're included. There are other notes that are just issued by the bank and there is no creation redemption process. So long story short, ETNs were invented originally to go places that ETFs couldn't. So like at the time, ETFs didn't do the VIX market. They didn't do like India was unable to ETF because you had to physically track it. So ETNs are sort of like saying, we're not going to go track it. We're just going to, we'll just promise that we'll track it. This is the bank saying this. So they work just like ETFs, but the one thing about ETNs that sucks is that if the bank is just over it, they can just be like, we're not going to do any more creations. And so if you haul creations, you kind of tear half the heart out of the ETF, and then you can get a price that deviates from the NAV. And that's happened a couple times. So they have that risk. But on the flip side, if it's something like commodity futures, if you hold the actual futures, you get taxed at an unfortunate rate, whereas an ETN doesn't actually hold them. It's just a promissory note. So people who hate taxes sometimes use the ETN for commodity futures or VIX futures. So they've got these like tax loophole benefits, so they hang around. But I think they have like 150 billion, which would be like 0.2% of all assets. Now ETPs to us is the larger word we use to cover everything. So you got ETNs, ETFs, ETPs are everything.
Perfect.
In Europe, they've got something called exchange traded commodities. I won't go into those, but they're just basically like, the thing is sometimes like in the US, like if you want to have a fund, you have to have like a diverse group of holdings. That's what a fund is. So sometimes someone comes along, Bitcoin ETF or gold. It's like we're not diverse. We're only going to own one thing. So you can't file under the 40 Act. So like the Bitcoin ETF and the gold ETF, they had to file under the 33 Act. So you could call those ETPs or ETCs. They're not quite an ETF, but they have the same creation redemption mechanism. So over the years, we basically had a question. Can you ARB the underlying with the ETF? And can you do the commodity warehouse situation, which is called creation redemption? If you could do that, to me, that's the heart of an ETF, and we'll let it pass as a sort of overall in the tent. And so ETNs pass that test, and so do these commodity like ETFs, which would be gold and Bitcoin. And so I think it's okay they're included, but they do slightly they can have different taxation sometimes. But generally speaking, they're, I want to say 4 to 7% of all assets, maybe.
Okay.
And then it's funny, there's stuff in the ETF form that's like double leverage. So even if it has ETF label, it may not be like totally safe. So we actually came up with this thing called the traffic light system, where we took the potential for nasty surprise or just any surprises, and we basically bucketed it into red, yellow, and green. And so if you had some stuff in there that was like could be like leverage or roll costs or stuff that retail might not be aware of, we give you a yellow or red light. And sometimes there are ETFs, which again sound innocent, but they're actually red light. And there's occasionally an ETN or an ETP that would be green light. The Bitcoin ETF to me, or the gold ETF, would be a green light, even though it's not structured under the 40 Act. So it can be I wouldn't necessarily say ETNs and ETCs or ETPs are bad and ETFs are all good. You really have to look under the hood regardless.
Interesting.
But that's sort of how the industry evolved.
Got it. And then last note, you talk a lot about creations and redemptions. And I know you talked about the warehouse example. Just a sentence or two on exactly what a creation is and a redemption is in an ETF.
Yeah. So let's say, okay, think of the warehouse receipt. Say that it's soybean oil, and you want a bunch of soybean receipts, and I'm a market maker. I deal in these receipts, and you and your buddies, and all of a sudden there's this demand for these, like Bitcoin. A lot of retail is like, oh, now I can get an ETF. I want the Bitcoin ETF. So all of a sudden you got all these demands for Bitcoin ETF receipts. Well, I don't have that many receipts. So what I'm going to do is I'm going to sell you receipts as a market maker, and then I have a day to settle it. So I'm just going to sell more receipts than I have, and I'm going to basically go out and buy Bitcoin to hedge myself because I don't want to be short receipts. So when I buy all this physical Bitcoin, at the end of the day, I'm going to hand it into iShares in the commodity warehouse, and they're going to give me new receipts, so I'm now flat.
Got you.
So essentially, that's creation redemption. Now, if a bunch of people want out of the Bitcoin ETF, you and your friends you all want out, and I'm going to have to start selling you receipts, right? And I'll start selling you receipts I don't have. Then I'm going to have to I'm going to buy your receipts. My bad. I'm going to be buying your receipts. Now I've got all the receipts. I don't want them all. So then I take them into BlackRock, get the Bitcoin, and immediately sell that on the open market, and then I'm clean. So the market makers are really the ones that engage in this creation redemption. But really, you got to think of it like they're kind of the wholesalers in between. If they see like red polo shirts selling out, they're going to go get more red polo shirts. Exactly. So it's a process that happens in the intermediary level. The end investor doesn't really care. They're just buying from each other on the secondary exchange. But the market maker, if there's too much demand, the price of the ETF may actually rise above the underlying a little, and they're going to arbitrage that. And so the people in the middle are like the oil that keeps the whole thing working. And there's the incentive to arbitrage is so great because they can create and redeem shares at any time. So they can always arb the underlying with the ETF if the price gets out of whack to the value of the underlying. So because of the creation redemption, arbitrage can happen. Arbitrage keeps the price close to the NAV, which is what you see out there when you buy and sell ETFs. And so a lot of this is happening behind the scenes, like the sausage being made. But the beautiful thing is the end investor gets a price close to the NAV, and they get it when they want it, how they want it. And that's how the system works.
Awesome. Let's go into the Bitcoin ETF a little bit, and then also talk about the risks of ETFs in general, using that as an example. I didn't realize that it took 4 years for the first ETF to actually get approved by the SEC. We were obviously waiting in the crypto space for a little bit longer than that. But take us through a little bit of the history of the Bitcoin ETF. We'll talk about the ETH ETF in a second, and kind of where we are with that and how big the Bitcoin ETF was in the context of all ETFs.
Yeah, so SPY took 4 years. The Bitcoin ETFs took 11. And it was crazy. I'd never seen anything like it, obviously. The SEC just wasn't into it. You know, like that movie, He's Just Not Into You? It's like they're just not into this. And we would make a lot of arguments that like actually ETFs can help clean up the underlying Bitcoin exchanges because market makers, the people I just mentioned, they're not going to deal with some shady exchange.
Yeah.
So if you want that retail money, all that cash flow, you better clean up your shop. So we thought the ETF should be approved because they would be like a natural police in the industry, but the SEC didn't see it that way. Anyway, they finally approved them because they got sued. And so they approved them. And when it came out, man, it was like a pressure buildup that had been popped. And the money came in fast and furious. There was a couple dynamics. You had 10 ETFs launch on the same day. 9, rather, sorry. GBTC
9?
converted.
Okay, yeah.
So
I thought it was 11.
GBTC wasn't exactly a fresh new baby. It was an existing trust that converted to an ETF.
Yes.
And it converted with like, I want to say 35 billion or something. And a lot of those investors, now that it was an ETF, were like getting the hell out of there. So that we call it the GBTC unlock. So people finally could leave GBTC. And so a lot of outflows are coming from GBTC, but then the new 9 took in more than GBTC saw out. So every day it would be like GBTC $1 billion out, new 9 1.5 billion in, GBTC 200 million out, new 9 300 million in. So the new 9 was doing a good job of taking in more than GBTC lost. It wasn't a one-for-one thing, but long story short, over the months after the launch, there was net positive flows, which is the key number because that's net the GBTC unlock. So right now we're at about 18.5 billion in net flows since they launched, which is tremendous. We thought it would be between 10 and 15 billion in the first year. They're already at 18 billion and it's a couple months to go. So I was surprised at a couple things at how much net flows came in. I thought they'd get big, but I thought it would take like a couple years. Then I was surprised at the staying power during the sell-offs. There's been a couple pretty nasty sell-offs, Bitcoin style, but 95 to 100% of the assets stuck. So only like 2-3% came out. The outflows were very minimal considering it was a 20% drawdown. So these are really strong investors. ETF investors tend to be smart. They're probably only allocating 1% to their portfolio. So this isn't their main nest egg. They don't need to panic. It goes up or down. Who cares? I'm just in this for 10 years, so I don't hate myself if it goes to $1 million. And I think you have some powerful educators in the form of BlackRock and Fidelity salespeople and Bitwise and ARK. And so you get all these like people speaking to advisors in their ETF language about how it fits into portfolio. And that's powerful. So these ETFs came to market with the 3 things that you need for a successful ETF category. You need liquidity. They all had liquidity pretty quickly. You need low fees. They all had low fees. They're all 20 to 30 basis points right off the bat. That's pretty cheap, especially when you consider GBTC was 2%. That's 200 basis points. Right. Go in other countries, they're all 1 to 2%. So for the fact that you can get these ETFs for 25 basis points was like miles cheaper than anything else in the world. And brand names. If as an advisor, you're thinking, okay, I'm going into this crazy asset class, but I got Larry Fink's stamp of approval. BlackRock is into this. I got Fidelity. I mean, come on, that's as TradFi as you get. So the brand names also give them a lot of cover and confidence that this isn't crazy, because advisors they have this career risk. They don't ever want to show a client something and the client go, "What in the hell did you put me in?" They can go, "Well, this is a BlackRock Bitcoin ETF." The client's like, "Well, if it's BlackRock, it must be, So it gives them a lot less career risk to do this versus buying, again, imagine if an advisor went to FTX, they'd be fired probably, and they don't want to be fired. So the intermediaries in particular love the ETF, and they love cheap brand name liquid ETFs. So this category had all 3 of those boxes checked within a couple days. And those boxes were checked faster than I thought. I thought liquidity would take a little longer. I thought the fees would start at 60 and maybe be whittled down to 30, 20 after a year or two. But they opened at 20. There was a fee war before they launched. And so all that stuff was really powerful, and it still is powerful. And I wouldn't want to be on the other side of that. There's a couple people who have been like, "Oh, who's going to buy these? These won't sell." And then after a couple of weeks, they were like, I just wouldn't be a doubter of the power of the ETF structure, low costs, brand names, and liquidity. I mean, those are just, not to mention all these smart wholesalers who have relationships with these advisors. So good luck doubting that.
Absolutely. And Eric, I read some things about how this was the fastest, quickest growing ETF ever. What is the validity of statements like that? And can you kind of crystallize what that was?
Yeah, sure. So I'll give you some numbers. So um, it is the fastest growing category I've ever seen. I mean, take any metric. Like, for example, the Bitcoin ETFs have 18.5 billion in net flows. It took gold ETFs 4 years to get to 18 billion in flows.
Wow. Wow.
And so we're talking 9 months versus 4 years. And gold was a hit. The gold
Yeah.
ETFs were a huge hit.
Yeah.
IBIT got to $20 billion in something like, I want to say 140 days.
And
The
IBIT is the
next
BlackRock
fastest
ETF, right?
ETF, that's the BlackRock ETF.
Yep.
So 140 days to 20 billion. The next fastest ETF to get to 20 billion was like just under 1,000 days. So it
Wow.
did it in like 7 times the speed.
Did you say so? 140 versus 1,000, you said?
Yeah, basically.
Amazing. Amazing.
Give or
Okay.
take a couple of days. I got to look at the chart, but that's ridiculous, right?
That's amazing. That's
So
really unbelievable.
there's probably 10 of those kind of stats I could rattle off.
Okay.
It's just
Awesome.
it's an anomaly in physics.
In physics, I like
It doesn't
that.
make sense. Yeah. And
All right.
so that's why when some of these crypto people start to whine about like a day or two of outflows, I'm like, dude,
Relax.
you gotta, you insane.
Yeah, absolutely. So let's talk a little bit about the risks, Eric. So we're an exchange. Obviously, VALR is the largest exchange in Africa, global exchange. We have a lot of, our customers come and talk to us about this stuff. One of the things I tell them is I said, listen, what's great about the ETFs is the fact that you can go onto your TradFi apps, you can just click a couple of buttons, and there you have it. You've got some Bitcoin exposure in your portfolio. The diehard crypto folk talk about, well, you know what? If this is meant to be kind of like a hedge against the system, ETFs, you don't hold your keys. You're taking some type of counterparty risk potentially. I want to talk to you in a second about what happened recently between Coinbase and BlackRock as far as the redemption time. I think it was the 12 hours. So what is the downside of an ETF specifically as it relates to Bitcoin ETFs?
The only downside, I think, to an ETF, for a true hardcore believer, I think you want your own wallet. That's the whole point, is that it's yours and the government can't take it. So you're not going to get that with an ETF. I mean, if the government were to confiscate Bitcoin, BlackRock would probably comply. So same thing with gold. There's a lot of parallels with gold. There are certain gold bugs who I think go beyond gold bug. They're like really like they have like a basement that has ammunition and canned goods and probably some
preppers.
physical gold.
Yeah.
I do not see that. I encourage those people to use wallet directly. The ETF's not for you, but I think the ETF is a great improvement upon some of the frictions out there and the costs out there. So it's also a very familiar structure. It fits into the plumbing. And so for a normal investor who wants to participate but doesn't want their own wallet, and a lot of advisors, by the way, they cannot custody their own assets. So it's illegal for them to have their own wallet technically because they are not allowed to be the custodian of the assets. It's better for it separate just in case the advisor loses their mind. By the way, these checks and balances in TradFi are, TradFi is mocked by the crypto world, but I'm sorry, you don't get an FTX because of those. I always say ETFs are SBF proof. You cannot get, even if Larry Fink lost his mind, the assets are not with him. He can't do anything.
But
so
let me challenge you there, Eric, a little bit.
Go ahead.
Because so right now, I think there were 11 ETFs, and 8 of those ETFs, so the Bitcoin ETFs, are custodied by Coinbase, if I'm not mistaken. So if Brian Armstrong lost his mind and he decided just to like exit, then basically the ETF is gone. I just want to be clear. Like there's an emphasis and reliance on the custodian. So even if you separate the custodian and the exchange,
well, let me ask you. So BlackRock has their own node, and they check their address every night, and they know how much Bitcoin. I mean, are you telling me that Brian Johnson could steal from that wallet?
Sure. Well, Coinbase is the custodian, right?
Yes.
So
Brian Armstrong. Sorry.
So in this situation, yes, BlackRock would be able to see that the coins are being stolen, but they wouldn't be able to prevent it. And the only reason that I'm saying that is that there's still reliance on one institution to custody those assets. And we're hoping that everything goes well with that institution.
Yeah. Okay. That's fair. And I think, you have to have trust in BlackRock. And so, by the way, Fidelity uses their own. I think Fidelity is their own custodian.
Custodian, I believe
I think one other one uses a different custodian. And I do think that if BNY Mellon, which I heard can start custodying too, we're going to see a diversification of custodians. That's normal. Like in the gold ETF area, they're not so worried about the company custodying it, but some people want them custodied out of America just because FDR did confiscate gold. So there's a gold ETF that custodies it in Switzerland, and it's got $1 billion because they don't want anybody mess. There's some that custody it in 3 different vaults. So there's going to be something similar that progresses with the Bitcoin ETFs. I think there'll be ones that maybe use a certain exchange custodian or not. Coinbase, certainly a lot of pressure, but I think here you have BlackRock on them every day. They're looking at the wallet. They're talking to them. They've got multiple other issuers. Also, the money for Coinbase is too good. Normally, a custodian gets a couple bips fee of the expense ratio. I heard that Coinbase gets 2 or 3 times the norm.
I didn't realize that.
Yeah. Wow. And so all these assets flowing in, they'd be dumb to that's a great business, man. All they got to do is just sit there basically. And like they get all this money from BlackRock wholesalers doing all the work, getting assets. They get like, I want to say they get 8, 9, 10, 11 basis points. It's almost half the fee.
That's unbelievable.
So why, the motive would be, that would take a real idiot. So they're also a publicly registered stock.
Yeah. By the way, I really don't think that's going to happen. I don't believe that's going to happen. I just wanted to look at the technicalities of what's possible.
This level of scrutiny, and I'm not going to say paranoia because, Lehman existed. I have some sympathy to, but this is the kind of mindset I think where you should get your own wallet. Like if you start down this road and you have these, get a wallet. Like there's nothing stopping you. For I'll call it like the 60-40 world. That's like a typical portfolio of stocks and bonds. The normal 60-40 world, the Vanguardian type advisor. This is fine for them. They're going to trust these firms. They're not worried about this. The other thing is when it comes to the ETF issuers, there's 3,800 ETFs in the US, and all of them use different custodians for stocks and bonds. And there's a process with all of those that has never had an issue in 30 years. And so there is a point where you have to go, okay, a track record matters. And for many of these companies, the Bitcoin ETF is a great little hit, but it's a tiny sliver. The revenue BlackRock gets from IBIT is so microscopic compared to their whole business. They personally wouldn't do anything. It wouldn't be worth it to them to mess with it. But on the flip side, they do have a digital assets team who is not going to let Coinbase off their radar. I'm telling you, they're not messing around. So I don't know. At some point, I think unless the crypto Twitter has a problem because BlackRock won't share the address. But BlackRock, I talked to them. They were like, well, the problem is if we share the address, we get enough spam as it is. We would get so much spam. We could get sanctioned Bitcoin put into our fund, which we don't want. So that's their answer for not providing the address every day. If I'm a crypto Twitter person, I just say, look, if you're what they're mad at is they think that the price should go up more when there's ETF flows. So wait a second, ETFs are buying, but the price hasn't moved up that much. It must be, instead of thinking, well, there's other sellers, for some reason they don't think well, there must be native holders who are selling. They can't think that. I guess it's unthinkable. They're like, is something up with the ETFs? And they get these tinfoil hat theories that Coinbase is selling shorting the ETFs, lending out the Bitcoin, and replacing it with IOUs.
That's illegal, right? So
it's illegal.
Yeah, exactly. Exactly.
So, okay, fine. That's your theory. Anybody who's gone that far probably owns their own crypto in a wallet. So what do you care? Absolutely. At some point, the price will go back up. Just chill. But the other thing is, I would just, if I was the people with the wallet and I was into Bitcoin, one thing they need to do is stop looking at the price every day. They're going to lose their minds
It's true.
because it's
Well,
already up 50% this year, and it's up like 150% since the ETF filing by BlackRock. You've gotten such a nice kick
yeah,
from the ETF. You really should be thanking Mr. Larry Fink
yeah,
for keeping your Bitcoin price up in the 60s. It should be like 30 probably without the ETF. They don't want to hear this, as you can imagine, because I'm like TradFi suit guy, but it's true. The
Well,
ETF has done a lot of good for the price.
I wanted to
And
ask you
so it's
about
kind
that.
of like just relax. You should thank the ETF. Just trust this. There's been no mistakes. Like have a little bit of like, give us some respect. And
Absolutely.
number two, you got to stop looking at the price every day. I would look at a rolling 5-year chart. Okay, we're up 650%. And there's like, oh, we're up 649%. Rather than we're down 2% today. Like, oh, we're
Absolutely.
still up 649 over 5 years. That would be
Absolutely.
my advice to the crypto world.
Got it. Thank you. Thank you for that. I wanted to actually, you answered it a little bit. I wanted to ask you about the price impact of this as well as the volatility. And just to be clear, at least our view, my view at VALR is that the future isn't one of TradFi and crypto, etc. We're starting to see the kind of merging of these worlds and just finance. Is this a new asset class, and how will that be treated? And so my thesis is very much that we're going to see banks in the future and others offering crypto assets. We're not going to have banks versus crypto, etc. That's a false dichotomy. So what do you get your views and thoughts on the price action because of this? And also, what does this do for the volatility of Bitcoin?
Yeah. So there's a lot of derivatives and algos feeding off the flows that trade in Asia. It's like a derivative market over there. And so a lot of the returns have actually come outside US hours. But a lot of the algos and derivatives action and leverage is somewhat riffing off the ETFs because that's the big narrative right now. I hope the Bitcoin grows out of just the ETF narrative. I think it needs the bigger, broader narratives that it used to have.
Absolutely.
Over time, I think that'll regulate a little. But the ETFs are the new thing, and they're taking in money. And so if they see flows in the US, they tend to leverage long. And so you get a lot of price action outside US hours. So that's the impact on price. But again, if you have an ETF filing in June of 2023, and it's now September 2024, which is like 18 months, it's up like, I mean, what is it, 170% since then? So I would call that impact on price. But ETFs still own only 5% of all the Bitcoin. Now,
Which is actually, that's pretty big, actually, also from
it's
another
pretty big.
perspective. I think.
I agree. Because remember, ETF's been around 30 years. They only own 8% of stocks. They already own 5% of Bitcoin. But I'd argue they probably own maybe 9, 10% because I think half of the Bitcoin isn't moving. Like
Okay.
Saylor isn't moving his, Satoshi's not moving his. And then you've got just people who lost their passwords and stuff or whatever they call them.
Yeah,
So
absolutely.
you've got frozen Bitcoin. So maybe half is actually the float. If you then ETFs own, 10% of the float maybe already. And we have this chart we're tracking where the ETFs own about 1 million Bitcoin now, and they're now the second biggest holder in the world. Satoshi owns 1.1. Well, by Halloween, ETFs could be ahead of him or her.
That is fascinating.
Isn't that fascinating?
That's really, really fascinating.
That said, there's a lot of individual owners. So if you add up the rest, it's still 95%. But it is interesting to see ETFs rise the chart that quickly. But remember, you're an exchange. The ETF is almost playing the role of an exchange here to a degree. You go to the ETF, even though you buy the ETF on exchange, they're sort of just doing the work for you of like storing it, and you just basically, it's an outsourcing. So you're outsourcing all of the work of getting the Bitcoin on your own. It's the same deal. So a lot of Bitcoin is outsourced. It just so happens that the ETFs are a bridge to the $36 trillion that advisors have
Absolutely.
and institutions. So you add up the institutional advisor professional money, you have a huge pool that hasn't been tapped really that much up until now. And so I think over the long term, it should have a positive impact on price because it's just opened up a bridge. It's like, okay, we're going to build a tunnel from New York to New Jersey. Do you think that'll have an effect on like travel, but people going to New York? Yeah.
Of course.
If you
Absolutely.
open up a lane, it's going to, help travel. So the ETFs simply are just bridges to be able to get Bitcoin more easily. So that should help in the long term. But again, the day to day, sometimes there will be moments where the ETFs had a good day, but the Bitcoin goes, I don't know. Who the hell knows what the hell's going on? So
Sure.
sometimes I ask these guys, they're like, oh, it's a leveraged degen flush or something like that. And I'm like, what?
Yeah.
This sounds like a poker hand or something. It's
true.
like
No, it's difficult to keep up. Eric, on the flows, is there any information about the institutional versus the retail inflows into those ETFs? Like, is this just managers, or is this actually guys on Fidelity, like the retail base on Fidelity, clicking buy?
Yeah, no, a good question. So another thing that just annihilated records was every quarter, all the professional people, institutions, hedge funds have to report all the equity holdings they have, and that includes ETFs. So in the first quarter that the ETFs were out, they launched in January. So the first quarter, 13Fs came out that showed a lot of hedge funds and advisors and even a couple pensions owned Bitcoin ETFs. We've now had two 13F filing periods. And IBIT, which is only one Bitcoin ETF, has 653 of these institutional holders reported. The average ETF that's launched this year is going to have 3 or 4. So 653 is insane. It's
record breaking, effectively.
It's like, again, it's an anomaly in physics. It's hard to even measure it versus other stuff. An ETF's happy to have 10 by the end of their first year.
Awesome.
And if you look at the number of institutions and you break down so right now, that 653 owns 20% of IBIT. The norm for a big giant ETF like GLD would be 40%. So over the next year or two, I think the number of institutions will grow and get to that 40% medium that we've seen with a lot of big boy ETFs.
So the remainder 80% is retail? Is that
Yes.
what you're saying? Wow.
It could be. Well, it could also be small hedge funds or small advisors, because you have to have 100 million in equity holdings to have to file a 13F. So you could be a real tiny RIA or hedge fund, and that would be not reported. But we'll call like small RIAs, and retail would be the rest. But that's okay. But if we look here, 34% of the 18% is advisors. If you take that number, it's well north of $1 billion. So even if we only took the advisor allocation to the Bitcoin ETFs, it would be, again, one of the top 10 launches of the year, just if we only looked at advisors. So, and also 20% of the holdings are from other countries, which is also interesting. So only 80% US. Over time, if I look at GLD, which I think is a great model for this, you're going to see advisors will be 60% of the 40% that institutions hold. Advisors are going to start to grow and grow. And then you're going to see, I think, probably the 80% in the US, 20% overseas will be about the same. So that's where I see this playing out. And then what you're also going to find is probably a couple more pensions. Right now, there's been, I think, Wisconsin filed that they owned IBIT. Give this 2 or 3 years, and we're going to see more advisor adoption. There's hedge fund adoption is pretty high. But you have to understand, the hedge fund, what they're doing, they're not necessarily long Bitcoin. The hedge funds are basically doing arb between the spot market, the futures, the ETF, and maybe even some other ETFs overseas. There's a lot of fun to arbitrage all this stuff because it's like a little bit of a messy area. It's not as clean cut as the stock market where there's been, eyeballs on it for like decades. It's newer. And so the hedge funds have found a way to kind of make some money in the arb of all that. But that's good. All that provides liquidity and shrinks the gaps between these places. And people, again, you don't want a price of the Bitcoin ETF to be too different than spot, to be too different than exchange, to be too different than the futures. You want those prices to converge. And the hedge funds are, arbitrage to me is sort of like, it sounds nasty. It sounds like, and it's Wall Street making money, but it's sort of like the way you'd put snakes in a cornfield. They eat all the they eat all the stuff that eats the corn.
Yep, absolutely. And it's very, very important for a healthy market, for the efficiency of prices, etc.
Yes.
So absolutely. As we start to conclude, what are your views or what are you hearing? Obviously, we've had the ETH ETF that's come. It's not been as big as the Bitcoin ETF, but in its own right, I don't think it has been anything to kind of sneeze at. But what are you hearing and seeing as far as the future of crypto ETFs?
Right. So to me, it's going to play out like precious metals ETFs. Again, I'm a big fan of patterns.
Yep.
Gold has 90% of the market share of all the precious metals ETFs. Silver has like 9%, and platinum and palladium have like 1% between them. Those are the four precious metals. Somebody came along and did all four in one. It's called Glitter. GLTR is the ticker. It has $1 billion. So that has like 0.8% of the assets. I think we'll see a similar thing play out. I think spot Bitcoin ends up with 80%. I think the other ones probably share 20, but it may be like more like 90-10 for a while. But there are more coins than there are precious metals. And Ether, the story is going to take longer to explain. You know, it's gold is easy. Bitcoin is easy. It's digital gold.
Yeah.
It's to protect yourself against dollar devaluation. It's just, that's it. So Ether is harder to explain to a normal person. But the wholesalers, like from BlackRock and Fidelity, are good at explaining things to the boomers. So over time, they'll be able to explain it. I think it'll grow. But I pissed a lot of the Ether people off because I use the metaphor of like the Ether ETFs coming out after Bitcoin was like the opening band following the headliner. You know, it would be like Sister Hazel having to follow Nirvana. And I nailed it. They don't bother me anymore because they saw what happened. The Ether ETFs just, the new ones are not strong enough to overcome the unlock from the Grayscale Ether ETF. And so until that unlock is finished, the flows will be flat or negative. Now, when the unlock is done, I think they'll slowly claw their way into positive flows. But even then, they've got to get, 3-4 billion to become, or 2 billion, I would say, to become 10% of Bitcoin. And 2 billion is going to take a little while. So
what are we at with Ether? What are we at right now?
I think it's the total assets. I want to say it's what's the Grayscale Ether? Ether? No, Ethi. There it is. It's going to be about what this one. Yeah, maybe like total assets 8-9 billion. But the problem is that's not the number to watch because the Grayscale came in with 10 billion.
Okay.
The number to watch is the net flows because that's net of the unlock. And I think that's negative like 200 million. It's like around zero.
I understand.
So there's been some inflows, like BlackRock's E3 ETF has $1 billion in assets, but the new 8 or 9, whatever, haven't been strong enough to offset the Grayscale outflows. Whereas the Bitcoin side, the new 9 were strong enough to overwhelm the outflows. And that was impressive. It was heroic. These aren't heroes. These are more mere mortal ETFs. That's, again, I go back to the Bitcoin ETF was just so unusual on so many levels that people shouldn't get used to it. In my opinion, the Ether ETF situation was and looks to be like a good success. It's just not anywhere near the anomaly, spectacular phenomenon that the Bitcoin ETFs were. Absolutely. So I think you have to change your relativity. But the Ether people were really giving me crap about lowering expectations, but they don't do that anymore because I was right. But I think over long term you'll see Ether get, and then long term you might see some XRP, Solana. Maybe they'll get into some of the coins. In Europe, they do 14 coins, probably 21 shares has a lot of different ETFs. I don't know where we'll get here. The election is a big variable. If Trump wins, I think we could see more coins get ETFized. If Harris wins, I think this will be it for a while.
Okay. Eric, my last question to you is you've been on a lot of podcasts. A lot of people have asked you some very good questions, but is there any particular question that you haven't been asked that you should have been asked, or some particular insight that you've just uncovered recently that you're dying to share with the world? It can be about Bitcoin ETFs or anything else, but any of your last insights or words of wisdom for our listeners?
Yeah. I think one thing that we just find interesting is, and it's a new theme for us, is that the ETF industry, I feel as though, is sort of in some ways becoming like the biotech industry. Whereas it used to be, okay, we're going to give you all these exposures. Here's stocks, here's bonds. Now between these ETFs that like have 100% downside protection, or write call options to give you high yield, which then buffers your downside, they're designing funds in a creative way using derivatives that help change your feelings. So, for example, if you're an older investor, you have a ton of money, but not a lot of time, and you're scared like hell about a huge crash.
Correction.
There's these ETFs that take your worry away. You give up upside, but you eliminate downside, and you can walk around in your retired life feeling like protected, just like a drug would give you that feeling. And on the flip side, there's a lot of young people who want adrenaline. And so they want like double leveraged this, that, and the other. Like the double leveraged morning MicroStrategy ETF is 15 times the volatility S&P, and it's one of the biggest hits we've seen in a while. Like it's like total degen, give me adrenaline, make me feel something, get me excited, get my blood flowing. And so there's this interesting evolution to like cure worry for older investors and basically provide fun and excitement for younger investors. And this is an interesting dynamic because the core vanilla stuff is already had. Nobody can innovate there. You can already get everything for like 3 basis points. There's really nothing to do. BlackRock and Vanguard will destroy you. So that's where the innovation is going. And I think crypto ETFs fit a little bit in the former. They're a little bit like a fun, volatile investment that would go in your hot sauce and that gives you some like, again, like some, it's exciting. And it's not exactly like designed with derivatives, but to me, it's part of that sort of more creation of hot sauce. And I think that's helpful because it fits in the modern portfolio and there's a demand for that. And so I think that the biotech mindset of the ETF industry is something we're playing with, and more products are going to be designed to make you feel something or make you feel nothing, to cure your worry. That's where I think a lot of the industry is going.
And we may see that in the crypto space. So as you said, we didn't talk about it. We've got a futures ETF. We've got the spot ETF. But what you're saying is that we could start seeing derivatives layered onto that, which would provide different type of payoffs for holding Bitcoin like on steroids or a little bit more tame.
Yeah. So we've seen double leveraged Bitcoin already, and they do good. And then we've also, I think we saw a covered call Bitcoin ETF filed. The next one would be buffer Bitcoin. I think there's one filed. And that would be like, hey, we'll take your Bitcoin and we'll limit the downside, but you give up some of your upside. So I agree with you. Bitcoin will be put through this biotech machine just like everything else.
Awesome. Eric, it's been wonderful to have you on the show. Thank you so much for joining us.
Great to talk to you. Thank you.
Thank you.